Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, September 10, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. So let's review quickly the activity from Friday, what we said leading into the latter part of last week, where we are today, where we're likely going in a few days, and what my projection is about what's likely taking place over the next several weeks. And I think you'll all be interested to hear the entire culmination from the shorter time frame, meaning what's happening in the here and now, all the way through what I think is going to develop really what takes us in through even toward the end of the year. So we're going to talk a little bit about that tonight. We'll begin to talk a little bit about those type of things as time goes on. There's no need to talk about the longer term every single night, but I started doing it a couple of weeks ago, and we're going to continue here and there. I'm going to add in some of the longer term thoughts because it helps bring together what I'm thinking in terms of the shorter term. And what I'm saying is sometimes you need to really understand whether you're in the midst of a trade with a trend or whether you're in a trade counter trend. And even though the shorter time frame can say, yeah, I'm with the trend, the longer time frame can say it's a counter trend rally, and therefore you need to take some extra precaution and potentially smaller share size as a result of those type of things. So before we get into the specifics, let me pause and thank everybody again for continuing to participate in posting comments under the video. They're helpful to everybody in the entire community. I really appreciate everybody's knowledge, everybody's thoughtfulness and participation with each other and for the benefit of each other. Please keep up the great work. In addition, please hit the like button on the video and also share the video with those people you think that can benefit from this information. Okay, so last week we said, leading into the end of last week, I would be interested to buy the S&P 500 or a like vehicle, SPY, options on the SPY, some of the leveraged exchange traded products or other just single exchange traded products. I'm not a real big fan of the leveraged exchange traded products. We've seen those from time to time fall apart. I'm not suggesting that's going to happen with the S&P, the Dow, the triple Qs, anything like that. That's not what I'm suggesting, but some of those quirky ones that track things like the VIX, and when the VIX explodes, something that's leveraged to the short side ends up collapsing because they're based on derivative contracts, and apparently when one of the underlying vehicles explodes in one direction or another, they can't roll contracts fast enough. Whatever the case is, I don't really understand the reason why, nor do I care to understand the reason why a couple of those things over time have collapsed. I just tend to stay away from the quirky ones. But let's get back to business. So we said leading into the end of last week, if we were to see, and we were likely to see at least somewhere in the vicinity of 287.51, but if we saw 286.38 or in that neighborhood, I was likely to become a buyer in that neighborhood at that price or in that zone in real time, depending on what the market was doing at the time. We talked about that last week, whether it was Wednesday or Thursday, I don't remember. But nevertheless, I said I would do it in real time. I would have to see an intraday reversal take place. And on a 10-minute chart, you can see here the market made a new low, reversed in the first 10-minute candle of the day, took off to the upside, and that was a pretty good indicator that I was relatively close to being on target with, at least from a timing perspective and an approximate price perspective, that blue dotted line, or at least in between those two numbers, the 287.51 and the lower number, at least that was going to be, from a time perspective, something that I was willing to buy, should have been the correct play, at least for at what I'm thinking is a multi-day rally. And now that brings us to where we are now and where I think we're headed in the near term. So let's go back to, and by the way, I could have done without this very deep retracement here. That wasn't helpful. The gap up this morning was helpful, but then we consolidated all day long and traded in a relatively narrow range, quiet day. Rather light volume all day, about 47 million shares traded in the spider. So that's less than the average daily volume. Right now, the average daily volume comes in at just short of 60 million shares. So while the market gapped up, it did sell off all day, but it never did really break below the important lows of the day that were made in the middle part of the day. So if that happened in the afternoon, I would be somewhat suspicious. We have a gap down here. They can always fill the gap and then resume to the upside. But let's go back to the daily chart and let's discuss what I think is taking place. So now that I think, at least from a temporary standpoint, a low is put in place. Now that may be only for a day or two, but at least from last week, the end of last week, I believed that a low would be put in place. That is, in fact, what happened thus far. So I think we can have a few more days of rally in the cards, but here's what I'm not sure of. Here's what we can't know yet. Is this a pullback that's going to resume and make higher highs in this market and continue the uptrend that is intact? The uptrend was never broken. All we did was what? Revisit home base, or the 20-period moving average. Didn't even spike through it by that much. Never did quite get to the blue dotted line, 286.38. We did make a low of 286.71. So it's pretty close, but we didn't hit it. Nevertheless, it was a zone. We discussed it at the time. So remember a few weeks back, I said we're going to begin looking for signs and signals of a trend change from a longer-term perspective. Well, we haven't really seen one yet. So the daily chart certainly is not indicating to us that we've seen a sign or a signal of a trend change. We made a top. We did not make it on extreme volume. We did not have a real reversal candle. Nothing really took place other than a consolidation or pullback, letting home base creep up to price, and at the same time letting price creep down to home base. That resets the stage. The uptrend is still intact. Just to point something important out, we look at the weekly chart and we want to say, well, has anything changed in a weekly chart? Is something available for us to use as a puzzle piece on the weekly chart that can't be seen on the daily chart with the naked eye? And the answer is not really. I mean, you can make a case last week was a reversal candle. However, it really wasn't accompanied by any kind of significant volume. So here's what I say by you can make a case that it was a reversal. So we got to close below the prior week's low. That's somewhat important, and let me go into that further in a second. The low from the prior week was 288.68. The low from last week, or pardon me, not the low, but the close, it's important where the close is, 287.60. So that certainly stands for something, and what else we did was fill a gap. Let me take that back. I don't believe we actually filled the gap. The low from last week was 286.71, and the official gap fill, as far as I'm concerned, is 287.51. So we did come up a few pennies short, but on a weekly chart, and eventually that will be filled on the way back down when this market corrects, but on a weekly chart for now, that kind of counts in the big scheme of things. We made an attempt, and they rallied away from it. So look how far away we are from home base on the weekly chart. We're pretty far. That'll come into play later when the market does finally have somewhat of a correction that lasts more than a day or two. Or in the case of last week, a little more than a week's time. You can see here the market made a high on the 29th of August, and the low was put in on the 7th of September. And that's just a temporary low right now. So what's next? So the question is, Can we make new highs? And the answer is yes, we can. There's no reason that we can't. However, I believe, based on my own work, that we're in the zone where we should begin looking for signs and a signal of a trend change, and we should have, at least from my perspective, a multi-week correction. And a multi-week could mean 2 or 3 or 4 weeks, probably more than 2, probably at least 3 weeks, but it could also be many weeks. There's no reason why we can't also have a 6 or 8 week correction. Anything is possible. We don't have to worry about the duration of a correction that might occur before one even begins to occur. Which brings me to my next point, which is the market, in my estimation, is going to do one of two things. And there's obviously two major things it can do, and there's some minor things it can do. We can just go back and forth here for a while, go sideways. That'll be an indication that the market wants to go higher. So that's another option. But right now, in the short term, I think the market is poised to at least make another or further advance from where we are. And if, in fact, we begin to get to the old highs and close above the old highs, I think we can make a new high. I'm not necessarily thinking that we can get very far, because we can either make a new high and we either do that or we don't. But at the same time, I think we either make a lower high or we make a slightly higher high. And either way you look at it, I think we come down and begin to correct this market to the point when you go back to the weekly chart, for example. Let's go back to the weekly chart and we see where home base is on the weekly chart. Let's just say 279. So I go back to the daily chart and I say, well, where can this market go on the daily chart that would still really keep the uptrend intact? And what I come up with is the 50-period moving average, which is right around 283. And just so happens that there's also another open gap that exists that at some point will be filled, comes in slightly below where the 50-period moving average is now. As time goes on, the 50-period moving average, along with the other moving averages, will creep up because they are in an uptrend, and as time goes on, each and every day, they're going to creep up a little bit. So the 50-period moving average will move slightly away from, unless the market turns down right now, will move away from this line. But there is a gap there. There's a 50-period moving average. So from a daily chart perspective, I would say that even if it spiked through that area a little bit, look what you have here. A very important breakup candle. We remember this one from before. This was a candle we discussed at length. Look where the lower portion of that candle comes in. Just so happens it's right around $280. The low of that candle is 279.16. You go to the weekly chart, your 50-period moving average is slightly below that, 278.94. So it's 279. So guess what? It's 280 to 270. 282 to 279 is our area if, in fact, the market made either a lower high and turned down, and we would know that, or we would be able to activate that type of forecast on the way down with a close below Friday's low. That's the way I'm looking at the market today. What's another way to approach potentially taking a short side for a trade like that? Well, I don't suggest doing it now because I think there's a few days worth of upside in the market, and there could be more than a few days. We could make new highs. So what I would suggest is looking for signs and a signal of a trend change, looking for the daily chart to give us some indication. If you want to drill down even further, you can look for an indication on an hourly chart. Either way, whatever time frame you take an indication from to take a trade off of, you have to have something to trade against. So right now, the only thing I have to trade against on the daily chart happens to be the all-time high. So I'm not willing to be short now against the all-time high, because I think if they begin to approach the all-time high, I think there's a fair chance they'll get through the all-time high. So I don't want to sit through a short position on the way up like that. That's the guy at the other side of the crap table. He's the guy playing the don't pass line, hoping everybody else loses. I don't like that feeling. It's uncomfortable. So right now, if we turn down tomorrow, for example, and we close the day below Friday's low, that's an activation for me. I'm going to say that lower prices are coming, and I would be willing to be short, barring a recapture of Friday's low. We'll talk about that if, in fact, we get to that point. We've discussed that before. It happens from time to time. If, in fact, we have to discuss that, we'll discuss that at that point in time. Right now, as you saw me discuss before, I'm long the market looking for higher prices from Friday's lower portion of the day. Now that brings me to another point which I want to discuss, and it's a little bit off the beaten track, but I think, or at least I hope, it'll be helpful in some way. So let's talk about counter trend trades versus with a trend trade. So I'm taking what I know could potentially be a counter trend trade to the long side on Friday. It's only a trade. I really don't have the intention for it to be a long-term trade. Could it turn into be, or at least in part, a long-term trade? Yeah, it could. I'm taking profit along the way. That's the way I operate. So whatever the final price target is that I take my last profit on a trade like that, it's not going to be what I started with. It's going to be some percentage of the entire position that's left over at the end. Could be half, or it could be less than half. So the fact that I believe that there's a pretty good chance it could be a counter trend trade, I take a smaller position. I'm not betting the farm on this trade. I did it through call options. I know exactly what my risk is. My risk is exactly 100% of what I paid for the call option. But here's the thing. If in fact I believe, for example, we begin getting below Friday's low hourly, and I just want to get out of the position, it's unlikely it'll be zero, so I'll take a loss in the position, but I won't lose the entire position, but I know my maximum risk, which is important to me on a trade like this. Now, if it was a trade that was going with the trend, I might have taken a larger position and even potentially be more lenient with the trade, but being that it's a counter trend trade, I'm looking to be in the trade, take the profit off the table, or at least lock in some profit pretty fast, see how high it can go, and get out of the trade. And that's my objective. So at this point, I think you should know pretty much where I stand as it relates to what my expectations are for the S&P 500. Now, here's the IWM. As you know, it's my favorite market leading indicator. So the IWM chart looks very similar to the spider. It's going to act and react in much the same way if I'm correct in the forecast. If we begin to make new highs in the IWM and even have not made new highs in the SPY, that's going to change the way I'm viewing things a little bit, because the IWM may be trying to tell me something else or tell us something else. So right now, the bogey in the IWM is a close above the last breakdown candle, which would be 172.48. Any daily close above that high, and that's going to be bullish for the IWM, and likely it's going to make a run for the old highs. Now here's a chart of the VIX. Now we're going to have a little bit of fun. So the VIX puts in a low here, all right, and Friday puts in, well, at least for the time being, at least between now and, or between Friday and today, or the close of today, that's the latest high. So what I want to do is ask all the students that have taken the course at lazyeMinitrader.com. Any student that's taken the course, I want you to tell me the relationship between those two pivot points, why they're important, and would it be important for the bullish case in stocks, the bearish case in stocks, or whatever else you want to interpret from that information. And please do me a favor, don't post it under the video. We're not giving away the secret sauce. It's just interesting. There's a lot of stuff going on there, and I want to hear some feedback. I want to see if you folks are picking up on exactly what I'm seeing as well. So let's go over to the transports. And the transports were up almost 2% today, over 200 points. Anybody surprised? Not that we could have predicted from, let's say, Thursday or Friday that we would have this type of day today. But what I will ask is, anybody surprised at the move? And the answer is, you shouldn't be, because we were above all the moving averages, we're in an uptrend, and we were consolidating sideways. And what does that do? It builds energy while eating time off the clock, building energy for the next move. The energy gets released, and it's a continuation move because the initial move was up, and then we go sideways, and therefore the continuation, which we saw part of today, is in the same direction up. So we consolidate, continuation up. Here we are today. Nice, big, healthy move. Most likely not necessarily the end. Now, if in fact we had enormous volume today and we were up like this, you could say that it potentially would have been an exhaustion move. But we didn't see that type of volume, so I'm thinking this is going to release more energy to the upside. There's more upside coming in the transports the way I'm reading the charts here and now. Anything going on worthwhile in the financial sector? Just looking at the XLF, not much happened today in the XBD, not important. It was down 33 cents, no big deal. And the same thing goes for the XLF, down 3 pennies. We're above all the moving averages. There's nothing wrong. We're really just consolidating, and what this is telling us is it's consolidating to make another move higher. Now, if we begin to break down below the moving averages, below some important pivot points, then that will be a different story, and I'll address it at the time. But right now, in the here and now, what I see is nothing but bullish behavior on the XLF chart. That's it. Nothing's changed. We've been talking about that for quite a long time. How about the SMH? Anything doing in the SMH? We had that tremendous down day the other day on Thursday. We had that big breakdown day. That was the energy that we just discussed in the transports. That's the same energy being released in the other direction. So we don't always get the continuation move. And when we don't get the continuation move, it's the same energy that's being released. So we still get quite a move. The question for the SMH is this a garden variety retracement? Or are we just filling a gap down here, touching the 100 period moving average? We didn't quite fill the gap. It's pretty close. Same thing we discussed before about the weekly chart. You know, it almost filled the gap. It eventually will be filled. But for now, it was an attempt at filling the gap. But here, it's pretty clear, cut and dry. Your bogey in the SMH is 108.66. As long as we remain daily closing below 108.66 in the SMH, that's going to be bearish for the time being. Any close above 108.66, that turns it back bullish. This was just a pullback pattern. And then the odds favor that we wind up with what? An ABC pattern like this. So the A leg is the initial leg up. The B leg is the pullback or the retracement leg. And then the C leg is the continuation leg. And that completes officially or technically once it gets above the high of the A leg. So it's possible. We don't know yet what's exactly going to develop. For now, above all the moving averages, it's okay. It's in really at least a bullish position as far as the daily chart is concerned. But below the high of this breakdown candle, it's still relatively touch and go, and we'll just leave it at that. I forgot the Qs, but we talked about the SMH, which is a pretty good proxy for the entire tech sector. And in the Qs today, similar to all the other markets, it looks the same. We're trapped underneath, or in between really, but underneath the 20-period moving average. We've got to get above that. You saw what happened when we came down in the Qs. Where did we come down to? We came down to an obvious area. The chart was telling us before that this was important because we basically, traded in and around this zone for quite some time. And then we finally broke out from that zone. And what did we do? We came back to test a former breakout or former breakdown area. That's exactly what happened, so nobody should be surprised. Same routine. Now we're getting that rally off that area. The question is, do we make new highs or do we make a lower high like we discussed in the SPY and then trade off lower from there? It's possible either way. We don't know yet. Let's just take it one day at a time. The market will tell us what it's going to do. And again, we may not be the first person to the party, but as long as we're at the party while everybody's having fun, that's okay. You don't have to get all the meat left off the bone. Once we get in, if there's going to be a correction, if I am right, I'm not suggesting I'm right just yet. I mapped out what I think is going to take place. Let's just say hypothetically I'm right, just for argument's sake. Humor me for a minute. At whatever point in time I'm able to identify the fact that the market has much lower prices on the horizon, I'm sure there's going to be pretty much enough meat left on the bone for everybody. Let's take a look at gold. So nothing really has taken place in gold of any serious nature that we need to be concerned with. This is a bullish pattern that's consolidating right around the 20-period moving average, building energy for another move higher. It's very simple. The bogey in gold is any close below 1213.30. Okay, any close on the day below that number, and you have to get out because we're likely going lower first to fill this gap, and then we'll see what happens from there. Or the alternative is, if this bullish pattern holds, then we're going to go up into the 50-period moving average, call it 12 and a quarter, 1225 would be the next stop on the upside, and then 1230 from there, or really, maybe even a little higher, 1230 to 1235 we'll call it. We're not there yet. It's way early for that. We've got to maintain this level, and we have to maintain daily closes above this breakup candle low. Otherwise, all bets are off, but right now it's consolidating to make a move higher. Crude oil. Crude oil is at an important place right here. Let me explain what I'm looking at. So we had that strange occurrence last week where I thought we would go and test 72 or even slightly higher. We never made it there. We put in that spinning top or whatever kind of candle, doji candle you want to call that. And I wasn't convinced that we were going to sell off from there. A, because I don't like where it occurred. Those traders that have taken the course at Lazy E-mini Trader know what I'm talking about, where the doji candle occurred or the tail candle occurred on the chart. I'm not in love with it. And secondarily, we could have went sideways to build energy to make a run for that 72 or higher number I was looking for. So I wasn't convinced that we were going to sell off. Now that we have, and had no dog in the fight either way, I'm just playing umpire here, calling balls and strikes. Now that we have, we're hovering on the convergence of the 20 and the 100 period moving average. So again, here's our bogey. Our bogey is right here. This breakup candle low at 65.98. Any daily close below that, and we're in trouble, and the weekly close is going to be even more important than that, because if in fact we're not going to make another push higher, if in fact we've made the high, then there could be much lower prices coming. We'll talk about that as time goes on. So let's find out what's going to happen in the near term. And our bogey right now is a daily close 65.98. We have to maintain daily closes above that number to keep the bullish case intact, at least to test that 72 or maybe even slightly higher than that number. Until and unless that happens, this is in a little bit of trouble here, hovering below or right on these moving averages. And with that, folks, I'm out of wind, so I'm going to give it a wrap here tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.